Hey everyone, welcome back to Corporate Decoder, the place where we unpack the dense financial documents that shape our world. And let me tell you, this latest report is a doozy. It has got more twists than a pretzel and a merger that is making waves. We're diving deep into DigitalBridge Group Incorporated's annual report to see what is really going on behind the numbers, and trust me, you won't want to miss this, so buckle up. And if you appreciate getting straight juicy insights from corporate filings, make sure you are subscribed and join our Discord community linked in the description below. It is where the real financial detective work happens. So DigitalBridge Group Incorporated, or as they call themselves, DBRG, has got a big deal. Brewing a merger agreement was signed at the very end of December 2025 to be acquired by SoftBank Group Corp. Through its subsidiary, SoftBank is looking to buy up all of DBRG's common stock for a cool $16 per S-share in cash. The preferred stock, however, will remain outstanding. This deal is expected to wrap up in the second half of 2026, but get this, it needs approval from DBRG stockholders and a bunch of other regulatory bodies, including foreign investment approvals and approvals from specific US agencies like the Federal Communications Commission. If this merger falls through, it could seriously hurt DBRG's business and financial standing, meaning all that time and money spent on the deal could just vanish. Now let's talk about what DigitalBridge actually does. They are a big player in investing and managing money for digital infrastructure like data centers and cell towers. At the end of 2025, they were managing a whopping $41.0 billion in what they call fee-earning equity under management, or FEEM. FEEM is basically the total money they manage that brings in fees. This FEEM grew by 15% or $5.5 billion in 2025. This jump was mainly because they raised a lot of capital for their third flagship fund called DBP Third. And some other investment vehicles, it is like they brought in a lot more money to invest, which is good for their fee income. But here is where things get a bit wild. Their total revenues took a serious nosedive. In 2025, revenues were $94.0 million, down from $607.0 million in 2024. That is a massive drop of over $513 million. The big reason for this huge swing is something called carried interest. Carried interest is basically a share of the profits from investments, and it can be super unpredictable. In 2025, they had a massive reversal in unrealized carried interest, which means profits they thought they had disappeared or even turned into losses on paper. On the flip side, in 2024, they had a big positive chunk from carried interest. So while their fee revenue from managing money actually went up by $44.8 million, the wild ride of carried interest made their overall reported revenue look pretty shaky. Let's break down that fee revenue that did increase, which is a more stable part of their business. Fee revenue went up by $44.8 million or 14% to $374 million in 2025. This increase was helped by bringing in more money for that DBP Third fund, which brought in an extra $41.9 million in management fees, including a good chunk of catch-up fees. You know, catch-up fees are basically fees charged retroactively when new investors join a fund later on. So more money coming in means more management fees, which is a clear positive sign for their core business. Now back to that carried interest that caused such a stir. In 2025, they had a negative $376.2 million from carried interest. What does that mean? It is like they had to give back profits they thought they had from their investments because the investments did not perform as well as expected. This isn't unusual in the investment world, but a reversal this large definitely stands out. It shows how profits in this business can swing wildly based on market conditions and investment performance. And of course, what goes up for the company often comes down for the employees in the form of compensation. That big negative carried interest number in 2025 meant a huge reversal in compensation expense related to incentive fees and carried interest. In 2025, this was a negative $137.1 million, which means they paid out way less in this type of compensation compared to 2024, when it was a positive $144.7 million in expense. It is a direct reflection of that massive carried interest swing. Even with all the market ups and downs, their administrative and other expenses actually went down by $50.7 million to $64.2 million in 2025. A big reason for this was a $22.2 million insurance recovery for legal costs incurred in prior years. So it seems they got some money back, which helped reduce their overall operational costs for the year. But hey, deals cost money, right? Transaction. Related costs shot up by $15.5 million to $20.8 million in 2025. The biggest chunk of this increase is linked to that SoftBank merger deal. Over $10 million was spent on it. So while they're trying to grow and change, they're also racking up some serious deal making expenses. Looking beyond the GAAP numbers, DigitalBridge also reports something called distributable earnings, or DAE, which they see as a measure of their realized earnings. In 2025, it jumped by $44.3 million to $96.8 million. This growth was fueled by that FRE or FEI related earnings increase, which, as we saw, is from their more stable fee. Generating business, it is like the engine that keeps the lights on is running stronger. Their fee-related earnings or free, which represents the core recurring fee income. They generate also showed solid growth, increasing by $34.9 million to $142.0 million in 2025. This is a good sign, showing their primary investment management fees are holding strong and even growing. When it comes to cash, DigitalBridge ended 2025 with $395 million in cash equivalents and restricted cash. This is a nice increase from the previous year and shows they have a healthy amount of liquid funds to keep operations running and to fund future opportunities. Their operating activities generated a strong $259.3 million in cash in 2025, a significant improvement from the $60.1 million in 2024. Let's touch on their debt situation. At the end of 2025, they had $300 million outstanding under their securitized financing facility, specifically the Series 2021-1 notes. This facility is their main corporate debt and it matures in September 2026. They are actively trying to refinance this debt before it is due. Now, about those dividends, they paid out $58.6 million in preferred stock dividends in both 2025 and 2024. That is a huge amount, but it is consistent. Remember that carried interest that caused all the revenue drama. It is a big part of their business, but it is also extremely volatile. As the report states, fair value of underlying investments is typically estimated using unobservable inputs and assumptions that involve significant judgment. This reliance on estimates means that carried interest calculations can be really subjective, and that is something auditors always look closely at. There is a lot to unpack with DigitalBridge Group Incorporated. On one hand, they're a leader in a booming digital infrastructure sector and their core fee. Generating business is growing, which is a definite strength. They're also managing a massive amount of money. On the other hand, the wild swings in carried interest directly impact their reported revenues and profits, making their financial results look very unstable. The proposed SoftBank acquisition is a huge event that brings both opportunity and a lot of uncertainty. If the deal goes through, it could mean a new era under SoftBank. But if it doesn't, it could leave them in a tough spot after spending so much time and money on it. They've got a lot of risks associated with market conditions, changes in regulations, and the ongoing challenge of raising capital. The company's direction hinges on successfully navigating this merger and continuing to grow their stable fee. Earning business while managing the inherent volatility of the investment world. It is a complex balancing act, so that is our deep dive into DigitalBridge Group Incorporated's latest filings. What do you think about this merger news and that crazy revenue drop due to carried interest? Let us know your thoughts in the comments below. If you found this analysis helpful, hit that like button and subscribe for more corporate breakdowns, and don't forget to join our Discord community linked in the description for even more financial insights. Thanks for watching, and we'll see you in the next one.